Welcome to episode 2033. We've got John Williams back today for part two of our very intriguing discussion. We'll have that in just a moment. But first, one of the things we are doing all the time to help understand what is happening with the economy, the macro picture, and specifically the housing market is we are constantly researching and looking into deep topics that are in kind of the background of the industry. And I thought I would share some research from an article I was reading this morning on one of those kind of background issues that really affects the market because it's about the mortgage industry. By the way, if you notice my scenery is different, I am here in beautiful Salt Lake City. We are hosting our collective event this weekend here, and I'm here a couple days early to do some business here at the beautiful Hyatt Hotel. They gave me this gorgeous suite. So it's just a beautiful hotel here. So that's why my scenery looks a little bit different. Anyway, Fannie Mae, the biggest part of the secondary mortgage market is definitely Fannie Mae. And they've notched $5 billion in profits in the last quarter, but they actually still expect a recession. Now, remember that there is a difference between a general recession and a housing recession. So let's take a look at this article. Now, this is a government-sponsored entity, of course, or a GSE, and the subtitle says, GSE said it now expects a 3.9% increase in home prices this year. So contrary to all of those folks out there who have been so terribly wrong and have missed so much opportunity calling for a crash, Fannie Mae, even with recession in their sights, is expecting an overall increase of 3.9% in home prices this year. So let's take a little dive into this article before we get to our guest today. It says Fannie Mae netted $5 billion in profits in the second quarter, and that was up, not down, up 1.22 billion from the first 3 months of the year in the first quarter. Executives attributed the swollen profits to continued strength in home prices, which have risen 5% in the first 6 months of the year. In fact, Fannie Mae is no longer predicting a decline in home prices this year. The government-sponsored enterprises forecast now calls for a 3.9% increase, though a recession is still in the cards. Quote, the economy has remained more resilient than we expected earlier this year, but we believe it is still on a decelerating path and additional drags are likely forthcoming. That's the chief financial officer. What else here? I want to share with you a couple of bullet points from this article that are really quite interesting. Now, remember, this isn't the overall housing market. What we're talking about is simply mortgage business for the biggest government-sponsored enterprise. And it says single-family conventional acquisition volume, so these are purchase money loans, was $82.9 billion in the last quarter. That was up 32% from the first quarter, which just clocked about 67 billion. So a 32% increase in conventional purchase mortgage volume. Of course, the refi market is largely dead. That would be the contrast. They'd be talking about non-purchase volume. Okay, purchase acquisition volume, 45% of which was first-time buyers. Wow, that's interesting. So first-time buyers accounted for almost half of the market. That increased to 76.4 billion from 56.5 billion in the first quarter. And refinance acquisition volume, this is, the almost dead market, was about 13 billion in the second quarter. And that was even up from 11 billion in the first quarter. That's amazing that refinance volume would be up. Like, that actually really surprises me quite a bit. But this point right here, folks, proves the point I have been making for many years right on this show. Go back and listen to the old episodes. You'll hear me saying this, right? I talk about how when people can't afford the home they used to be able to buy, they simply compromise. They accept less. Life is nothing more than a series of compromises and trade-offs. You never get everything you want. And this absolutely proves that. I mean, a purchase acquisition volume last quarter of nearly half of the overall market for mortgages is truly staggering. Why is that so staggering? Why does that just really make the point? Well, it's because those people aren't trading equities. They were buying their first home in a market where the cost of money has essentially tripled. I mean, think about that for a moment. And half the market is still first-time buyers going out into the marketplace and buying homes, even though affordability is at a 37-year low. They are simply learning to accept and take what they can get, right? And that's the thing that happens. All of the people out there thinking it's kind of this linear thing of you have this home buyer that is going to buy this home, and now this home buyer can't afford this home. So, the market's going to crash. That's what they think because they just don't understand how things work. What they don't know is that this buyer that now can't buy this home now buys this home down here. They buy a lesser home. Obviously, 45% of the market, first-time buyers, absolutely amazing. Fannie Mae provided just over $100 billion in liquidity to the mortgage market in the last quarter. The average single-family conventional guarantee book of business in the last quarter declined slightly by $1.4 billion. Okay, very slight decline, not a big deal. Credit characteristics, though, and this is really interesting. The credit characteristics for single-family conventional remained strong with a weighted average mark-to-market loan-to-value ratio. You ready for this, folks? Of 51%. Oh my gosh, that is truly shocking. That means people are putting 49% down. That is a bet on the future of the housing market right there. It means people have a lot of faith and a lot of cash that they are putting 49% down. And get this, it's even better. And a weighted average FICO score at the loan origination of 752. Amazingly good credit. I mean, 720 is considered excellent credit, anything above 720. And the weighted average FICO score, 752 as of June 30th. Absolutely incredible. Now, let's talk about delinquency rates, and we talked about that recently on another episode. Single-family serious delinquency rate, okay? These are the people over 90 days delinquent. They consider them serious delinquencies, right? So they didn't make their mortgage, they skipped their mortgage payment for 1 month, then they skipped it for another month, then they skipped it for a third month, and they still didn't pay. So they might be 4 months or 6 months or 8 months behind. Maybe the foreclosure process has started, maybe it hasn't. But this serious delinquency rate declined to 0.55% from 0.59%. Remember what I've shared with you before. If you just sort of average it out over decades, the typical default rate overall about 1%. We are much lower than that. So where is the distress in this market? Show me the distressed sellers and I will show you that a housing crash is coming. But there's simply no data showing this. Please disagree with me. If you're watching on YouTube or another video platform, comment below and just tell me why this is different or why you agree. Would love to hear either way. And please, by the way, make sure you are subscribed to the podcast and subscribe to the channel. A lot of you viewing, we can see in the statistics, that are viewing the videos aren't actually subscribers. So make sure you don't miss anything because we'll keep you informed of the story. Okay, Fannie Mae's net worth increased to $69 billion from $64 billion just a quarter ago. So Fannie Mae is doing great. The credit scores, the underwriting on these loans are great. The delinquency rate is super low. People are putting a lot of money down. They've got great credit scores. First-time buyers are almost half of the market in terms of Fannie Mae loans. That doesn't count FHA or VA, which is mostly first-time buyers. Truly, absolutely, staggeringly positive news here for the housing market. And remember, next week, I hope to get to this. I've got a big study coming for you on rents and the direction of rental income for investors for your properties. So stay tuned for that. Let's get to our continuing discussion with John Williams. So here we go.
It's happening in California right now, and a lot of people don't know this, but California has this goal of getting CNBCs talking about it. It's on california.gov, but they want to build 2.5 million homes by 2030, right? So it's like they have a population of 40 million. They have 14.21 million homes, and they want to add 2.5. So they want to basically add 17%, 18% of inventory.
It's a huge number, yeah.
So it's like, how the hell would they do that? Well, the easiest way for them to do that, I believe, is likely going to be not just ADUs and little small little wins like that for them.
Accessory dwelling units. Yeah.
Yeah. It's going to be massive property repositions of either commercial or residential, even things like storage. Like they're going to start converting things to housing. Mm-hmm. And the question I have is like, okay, if they move, even if they don't bring 2.5 million, let's say they bring 1 million. If they start to do something to where they impact supply at that type of level, and the average investor bought deals in California in the last 5 years at a 5% return, and they increase supply 10%, and then insurance and taxes are continuing to rise, then utility bills are going to continue to rise during this quote unquote green energy transition.
Right.
How do any of these deals make sense? So unless you own that property and you got a really good cost basis on it, like a lot of people with a lot of leverage are going to get smacked in California. Mm-hmm. So that's why I think the next couple of years is strategy is going to be so important.
Okay, so what's the strategy?
Buying value add, but not just basic value add. For example, if you were to buy, let's say you're in Los Angeles, I know LA. So let's say you found a deal near USC, not that far from campus, but you found a major fixer and you're able to buy it for $600,000, right? Let's say you had $200,000 down. So you got a loan for $400,000. And you bought this one little house, but there's an alley in the back and you can add 3 or 4 units and you can do so at a cost-effective level. Mm-hmm. Something like that might make more sense because you can build up these units with all these new upgrades already in place. And you can rent out, and then you have 5 units with a 30-year fixed rate loan in the front house. That would give you a lot more flexibility to be able to pivot with rents and regulation. Mm-hmm. So finding things like that to where it's not too much to bite off for the average person in California. But one thing you don't want to do is run out there and let's say buy an old 1910 building in downtown LA where you're hit with these new regulations and you have to do these regulations where you maybe have neighbors on both sides that are connected to your building.
Right.
And now how do you do this? If you have to reposition the envelope of the building and you have 2 neighbors that are cemented to your walls, exterior walls.
That's a lot of new litigation is what that is. Yeah.
So kind of pivoting these new energy mandates and pivoting debt and pivoting cash flow and being able to control costs, I think is going to be smart.
Yeah. And don't buy anything in California, though, in my opinion, because just don't buy anything in a blue state, because that's where this will be the most intense and the most oppressive, and everything else will be too. So just go for landlord-friendly markets, red states, and places with, right-leaning government that are more about individual liberty. Let's kind of back up a little bit, John, if we can, and just give us your broad view of where we are, where we're going in terms of the economy, the markets, investment choices and strategies, whatever you'd like to share there.
All right. So broad view, I believe that the wealth that's going to be, some people would say lost, is not actually lost. Money is never lost, it's simply transferred from one group to another. And so making smart, well-informed decisions in advance will make sense. If you're looking at everything that's happening on the world and you're not connecting the dots, then you're a fool. People need to really connect the dots. America as a whole is being crushed from within. The last couple of years have shown that. And you look at, look at what's actually going on. We're giving so much authority and power and leverage to other countries to grow and expand their wealth. And America is just becoming a very high tax, high cost living location. And I think the next 5 to 10 years are going to be not the prettiest for America. But I'm not saying I love America. I love America more than anywhere. But I just looking at the facts, that's what the facts say. But I do think there's going to be a lot of money to be made, but it's just, I think there's going to be a lot of curveballs coming too.
Mm-hmm. So the question with that, and I agree with you completely, the question is compared to what? That's just all over the world.
There's a lot of locations where, and like I'm looking into this now, and a lot of people are getting second passports and kind of like having, like, of course, there's other locations, like compared to what, definitely. But if you look at, let's look at a place like Costa Rica, right? Costa Rica has some benefits for sure, but they also have some really big downsides, right? And you look at a place like Dubai, they have some benefits, they have some massive downsides. And you look at other places, right? The same thing is true, but just having that ability to pivot, if one area gets really bad, you can kind of like, you have options in other areas. So I'm not saying to like leave America. I'm not saying anything like that. But I'm simply saying options are key in the future. I think real wealth is going to come down to options.
Yeah. Yeah, I agree with you. And that's one of the nice things that wealth does give you is it gives you options and it gives you more autonomy and control over your life. I do want to say on that second passport note, remember, you don't need a passport to actually just go live somewhere. There's lots of places you can go live without citizenship, okay? And beware, because there are a lot of scams in that second passport world. I've looked into it. I've done shows on it. So just be careful. That's I just want to point that out for people. Okay, yeah. So having options and autonomy, certainly good. Anything else?
Yeah, I mean, the people that you have around you, like you want to have really, really good people around you. I think that's going to be extremely important. I think a lot of people have learned this the last couple of years. Relationships have either flourished or suffered the last couple of years with a lot of people close to you. I can almost guarantee it. Same thing has happened to me. Same thing I'm sure probably happened to Jason. So having really good people around you, really being a forward-thinking entrepreneur and paying attention to these new rules, laws, and regulations that are coming. Build businesses online that are scalable with low cost and kind of diversify your way into the future, I think is all going to be good advice.
Yeah, I couldn't agree more, John. Having that network of people you can tap into and being around people who are thinking about this stuff instead of just being the sheep that are kind of the apathetic ones, just kind of going along with the flow. You've done a lot of shows on the areas in which government and the elites are trying to restrict our freedom or gain more control, surveillance over our lives. And one that, we're both thinking about and a lot of others are thinking about lately is the central bank digital currencies, the CBDCs, that ultimate surveillance tool is being able to not only surveil, but control how people spend money. And the idea of losing spending freedom, having that attached to our behaviors, our social credit scores. What are your latest thoughts about that?
I don't think CBDCs will be everywhere right away. I think it'll probably be like a slow drip. I think America is going to be one of the Europe, they're going to be much more strict and much more aggressive. Australia, before some other locations. Like I think some other locations that have major financial hubs, like even Switzerland, like they're working on a CBDC. I don't think it's going to be as aggressive as America off the bat because their entire economy is supported by global investment. And if people start to think that they're going to move, they're holding a third of the world's wealth. If people start to deem it as a risk towards storing their wealth, that's going to be a big problem for Switzerland. So I think look at Switzerland, you look at St. Kitts and Nevis, you look at other locations. I think that they're going to try to do their best to try to continue to be a tax haven and to be, but Switzerland's not really a tax haven, but be like a financial hub. So I think some markets are going to be worse than others. So, having potentially bank accounts in different locations, I think it's going to be important. That's one of the reasons also, like I love America. But at the same time, I know that this CBDC is going to be coming, like for sure. FedNow is launching now, right? Or in a couple days. So you look at that, like.
Tell us about FedNow and how that's the precursor to the CBDCs.
So how FedNow works is before you would use a bank and it would basically be you going through your bank, sending money to another person's bank, and then that consumer would have access to it, or that business, right? But now the consumer, say me, and say I wanted to send money to Jason, I would tell Merrill Lynch or Chase Bank or Wells Fargo, whichever bank, send Jason 10 grand. Then it would go through FedNow, and then FedNow could either approve it or deny it before then giving the permission to Jason's bank, Chase or whatever, to send it to Jason. So it gives them like the ultimate authority to give yes or no on transactions. So if they bring in the CBDC, it easily just plugs everything together.
Right, right. So can you imagine your transaction can not only be vetoed by your bank, because banks are doing that a lot since the Patriot Act and the KYC laws that have become so strict, and all the banks are so scared, of course, unless you're a big drug cartel, then they're happy to help you, right? Because you're doing a lot of transactions. But if you're a normal person with normal amounts of money, banks pull your wires all the time. They think, oh, this is money laundering, or this is a suspicious transaction. And, I've noticed on my wire transactions the last couple of years, the bank is now asking, what is the reason for this wire? And I'm like, none of your business. Like, yeah. what do I have to, I literally say to them, do I have to answer that question? Or are you not going to send the wire? And then I answer it with some vague thing. And well, we have to ask, they'll say. You try to open a bank account now, and you're looked at like you're a suspicious character. I just want to open a bank account. And if you think that's getting worse in the United States, which it is dramatically, if you're an American, try doing that in a foreign country. You have a scarlet letter on you. They do not want to touch an American, okay? Because the US has such a long reach, and the US can pull so many strings for all of these countries. I'll just give you one example. When you look at like these Caribbean nations, for example, and you mentioned St. Kitts and Nevis, that's a haven. The Cayman Islands, that's another haven, right? And the government and the elite class, they love hurricane season. Because whenever the hurricane seasons roll through and it hits those little Caribbean nations, they always need aid. And the US says, hey, look, we'll help you. We'll send you some money. We'll send you an aircraft carrier to help you out, purify water or whatever, whatever you need. But it comes with conditions. There are strings attached. You've got to tell us who's banking with you. You've got to implement this new set of rules and laws with your banking system. It's that old saying, the long arm of the law. Well, the long arm of the United States is really long, and they can just control all these other countries like puppets. And the Obama administration attacked Switzerland years ago, and it was successful. A lot of these Swiss bank accounts, there's no longer the way it used to be. And I'm not saying, by the way, this is all bad, because I don't want people evading taxes. I want them to pay their share. Look, I'm paying, okay? I want the other guys to pay too. But it just sort of creates this climate of they're just closing in on it for everybody, right? The walls are closing in, and they're giving people nowhere to run. So as soon as they can tighten that up, then they can increase the level of taxation and oppression. And that's the problem.
I agree to a certain extent, but I also think that if you have all of your eggs in one basket, which I'm like concerned about America expanding its grips, they're not going to grab anything harder than the American people now. They're going to grab like that. And so they're going to try to push, sure. But if you have options overseas in different locations, I think that's going to be valuable. Because you look at what's happening now, we're going to witness, I believe, a massive bank consolidation in America the next couple of years, commercial real estate problems. If we go from having thousands of these small, 4,000 plus of these small little regional banks, and then it goes down to where JP Morgan, Chase, Bank of America, Wells Fargo, Citi, these banks own market share. Oh, they're going to have more authority and power, and they're going to have a monopoly over the banking system. And when they have that,
they already have, their monopolies are already way too big.
No, it's going to get worse.
Yeah.
Like it's going to get way more extreme than what we're seeing now.
So
I like the idea of, looking at overseas in certain markets. Of course, do your research. I'm telling people what to do. But if you're sitting on some money, I would bet that in the next couple of years, you would probably be thankful to have options if those options are well thought out.
Yeah, yeah. Good stuff. Okay. Anything else you want to share, John? Just a question I didn't ask you, a topic that maybe you're covering on your show that our listeners need to hear about.
Well, I think one of the really, really big concerns going forward, I think that a lot of people are also banking on inflation going down. I'm going to be one of those people that are going to say that I think inflation is going to get much, much worse in terms of everyday food costs.
Oh, and I agree with you completely. Yeah.
And I think that also people might disagree with this, but I think rents are going to go down in a very dramatic fashion too.
Oh, really? Interesting. I think that's the opposite. Tell us why.
So a couple things that I think are happening right now. If you look at what's going on, you actually shared, what was it, 20% of homes are without mortgage? What was
Yeah, 42% of the homes have no mortgage, and then the rest of them have very low rate mortgages.
Okay, cool. So if you look at it's like I think something like 99% of mortgages are below 6%, some number like that, right? And so if you look at this and you're like, okay, 99% of mortgages below 6%, large block of investors own properties outright, no mortgage, right? 1.7 million housing units under construction that were, they thought they had buyers at 3%, 4% mortgages. Now a lot of these buyers can't qualify, right? So you have all of this inventory. You have retirees that thought that they had the retirement plan tucked away, Social Security, they were going to live in a 2 or 3% inflation world. You had all these people that were thinking everything was going to be completely normal. But now you have a lot of these property owners that soon could be upside down on their properties. But what are they going to do? They're going to do one of three things. They're going to find a way to pay that mortgage, rent out rooms in their house. They're going to rent out their property, or they're going to walk away, right? One of those things. But they have a 2 or 3 or 4% mortgage, and they have a pretty low cost basis. Odds are they're going to want to try to hold on to that property. So what are they going to likely do? They're going to say, hey, if I can rent out my house, I'm going to try to rent it out, try to weather the storm, right? So you have a lot of these people that own these homes outright. They don't want to sell in this inflationary world. They want to bring in some cash, right? You have a lot of landlords right now that are going to be renting out their properties that 1.7 million houses hits the market. They're going to likely trade to private equity. And they're going to rent them. You're going to have a lot of these potentially office buildings.
Let me encapsulate your theory there. Well, the office building conversion is prohibitively expensive, my friend. I mean, that is just very expensive to convert that to residential.
Well, right away. I think that's going to be like more of a 5-year thing. But I think what's going to happen is we're going to start to see a slow drip in some of these conversions. And I think the zoning laws are going to loosen up in a lot of cities to where it become more achievable.
And I think the zoning laws need to loosen up in a lot of these cities. But I'll tell you something. Let's talk about the office conversion thing for just a moment. And then I want to go back to your interesting theory there. The office conversion to residential is prohibitively expensive. It just does not make any economic sense. However, what does work is converting office buildings to homeless shelters. And some cities are doing this because they don't have to replumb and give everybody a private bathroom. And that's super expensive. And they don't necessarily have to, create windows that open, which is required mostly for residential, and office buildings mostly have a glass sheath and climate controlled, right? They can have the homeless people share the one bathroom down the hall, just like the office people do, right? And so that conversion actually works, and it has happened in a few places, and a lot more cities are talking about it. But guess what happens? As soon as you start converting your downtown to homeless shelters, nobody wants to live downtown
Values tank
anymore. Yeah. And so the downtown core city values, just no one will be interested in living there. No stores will be interested in opening there or staying in business there because of the clientele you're going to have. Now, ideally, in a normal world that rewarded the right things, which is not the world we live in, we all reward the wrong things, sadly. But the homeless people would pick themselves up and they'd just get a hand up rather than a hand out. They'd pick themselves up and they'd become productive members of society. That's what should happen. But the reality is we have a cycle of dependence, and the government rewards that because they want it, because that's the way they get the votes and so on and so forth. It's disgusting. So that's one thing just on the office building conversion issue. I wanted to say anything on that before we move on.
Yeah. So I think what a lot of people also don't realize is now people, maybe they do, about 40% of income in most areas goes towards rent, right?
Yeah.
So
in Miami, it's 50%.
And same with LA, right? And so when you have a market, right, or a world where household inflation is costing the average family $11,500 a year to maintain their former standard of living 3 years ago, right? What are they going to do when food prices rise, gas prices continue to rise, car insurance, everything's rising? Who are they going to feed first? Their landlord or their kids, right?
Yep.
What I think is going to happen is I believe we're going to see a lot of investors chasing tenant quality more so than maybe that sky high rent. Like if I was a landlord, had 10 properties that were paid in cash, would I care about getting market rent or above market rent? No, I'd want to get that tenant that has cash in the bank, great credit, that can give me security. They can pay me a few months up front. They really give me peace of mind. I think landlords are going to be chasing tenant quality, and they're not going to be chasing returns as much. And we see this with tons of new inventory hitting the market with a lot of these accidental landlords that never intended to become landlords because of they locked in these mortgages the last couple of years. So like, oh, I want to move to Florida. I want to move to these other areas. I want to move away from my high tax city. But now maybe they're having second thoughts. Like you're going to start seeing a lot of people that can't sell their properties become landlords.
But what's interesting about your theory, and I disagree with you, by the way, and we talked, I think you could sense that from when I was on your show, because your theory is interesting though. And here's why it's really interesting. What you're saying is because people have very low mortgage rates, like you said, 99% of people have a mortgage at or below 6%. And then, you get much lower than that. And that we've shared those percentages a lot on the show. And then 42% of the people have no mortgage at all. So what you're saying is because people have such low carrying costs, they will just rent their house for the cheapest price. They will compromise more on the rents because of their low cost. What?
I'm saying the ones that have no mortgage, they're going to be focused more on tenant quality. Like they're going to be really looking for the tenant that can really pay. The person that has a low mortgage, they're going to obviously want a great tenant as well. But if they don't pay their bills, it's not going to make sense for them, right? They're probably just going to give the keys back to the bank. So what I think is going to happen is going to be landlords as a whole. It's going to go from a world where everyone's chasing a fat yield to chasing security.
Okay, so that may be true. And when times get tough, people do get more security oriented than opportunity oriented, unless you have some vulture capitalist, right? That are opportunity oriented in that market. But the thing is that if you have more accidental landlords, as you put it, right? Like Airbnb conversions dropping down into the regular long-term rental market, which is happening, and Airbnb is largely a bust. You have more accidental landlords. There are people that did not let go of their house. They kept the house. So you have lower housing inventory. You have a continued low supply of housing for sale inventory. And you still have the problem, John, of increasing household formation and not increasing household inventory. And that's the hard fact that just only fixes itself with really liberal zoning and no requirement for net zero and environmental stuff and allowing people to construct lower quality, cheaper homes and incentivizing them to do it. Unless you have that, unless you have some massive increase in supply, it doesn't matter if it's for sale or for rent. You got to have more just houses, regardless of which path they are. That's my thesis.
Yeah, I mean, I think that a lot of people have talked about a housing shortage, and there's no doubt that we're in one right now in terms of inventory. There's very limited inventory. But I also think that a lot of people are looking at the economy, looking at the stock market, looking out, and they're saying the world's not that bad. Like everything looks pretty good, right? Like it makes no. I had someone on the podcast yesterday, and I was like, he's like, "What do you think about a market crash?" I'm like, what's crazy? Home prices are the same today, basically, in most markets than they were with 3% mortgages. Like when in the world have we seen mortgage rates nearly triple and home values stop? And because of that, people are looking at like, hey, on paper, my net worth is the same. Like I'm fine, doesn't really affect me, right? But I don't think it's sustainable. I think that we're witnessing a situation in which it's not just going to be, these quote unquote accidental landlords, not just going to be Airbnb. It's not just going to be retirees that are pushed into a corner. It's not going to be people that can't refinance their homes. It's going to be a slew of situations in which it's going to force people to do things that maybe they didn't otherwise consider in 2023, potentially in 2024, and into the future. We're going to continue to see, I think, a lot of change and things that will happen that no one really anticipated.
Yeah, I think we both agree, even though we disagree on how the real estate's going to play out, I think we both agree that the standard of living is going to decline and that people are going to have to accept less as the middle class gets hollowed out. And so what we hope to do on both of our shows is help people move up and not down, right? That's what our mission is. I know it's your mission. I know it's my mission, to basically end middle class poverty. And the pressures are just increasing on the middle class. The poor get taken care of by the government. The rich take care of themselves because they're engaging in all sorts of financial engineering. But it's the middle they're the ones that are under the most stress.
I 100% agree. And I love your show. And I think that what you're doing, teaching people about real estate and helping them get into really good deals, will always matter. Whether the market goes up, down, sideways, if you're buying a good deal and you're buying it at a good price point that is cash flowing, like you're going to do well, right? If you have to pivot a little bit in the market, it doesn't really matter, because what's the alternative? To sit in fiat currency that's going to get eroded over the next couple of years. Like, investing well is going to matter. And I think that, everyone here is going to, study and learn and make smart, well-informed decisions and make money while everyone else is kind of not paying close attention.
Yeah.
You can eat their lunch.
And that's the opportunity for sure. No question about it. Well, John, it's always so interesting to talk to you. We could do this for hours. We could definitely do it for hours more. But give out your website, tell people where they can find you.
Cool. You guys can check me out on YouTube @This is John Williams, or Instagram, same handle.
Excellent. This is John Williams. All right. Thank you so much.